Hey, I'm Gene Goldman, and today is Monday, January 9th. Here's a look at the week ahead. Last week, great news. U.S. equities moved higher, driven by a rally on Friday. This rally was triggered by more evidence that the Fed is winning its battle. Inflation is starting to slow down. So, for example, we saw on Friday the payroll report. We saw evidence that wage growth was slowing. Similarly, both ISM reports last week continue to show a drastic drop in prices paid. So now this week, Thursday, we get the December CPI report, and we should see more clues in terms of, is this disinflation continuing? If you look at the numbers, the consensus expects the headline CPI to decline a little bit and be flat for the month. If you look at the core CPI, where you take out food and energy, the consensus expects a slight uptick from November's 0.20 to 0.30. But don't fret, base effects should slow the year-over-year number from 6% to 5.7%. That's the consensus, but we think that we could see even lower readings for three reasons. First of all, number one, we've seen a big drop in energy prices, oil, gas, natural gas. This all should flow through CPI. Second of all, on the goods side, the slowing economy has impacted holiday retail sales. This should lead to discounts at retailers, putting downward pressure on prices. Also, we've seen sliding used car prices, also downward pressure on goods. Third of all, we're starting to see moderation in rents. You see here, we tweeted this last week. Rents are starting to ease in a pretty big way. This is huge for deflationary trends. The overall takeaway, we continue to see evidence that the Fed is winning the battle against inflation. The markets need to see more evidence of this to suggest that the Fed may be able to start to slow rate hikes. We get CPI this week. It's another piece of evidence in terms of where inflation is headed. Thank you for listening. For more information, please follow us on Twitter at SateraIM, and we'll see you next week.